in such a case? I just track where all the money went out and where all the money came in between 1st and 16th of February. That is all what we do, especially when you talk about a cash flow statement out there. Right, there are two methods of doing it. Normally, they will say there is what is called as, they will normally write what is called as a direct method, and there is an indirect method. Let us not worry about this, trying to understand what is this direct method, what is this indirect method, etc. Because if we spend time, then we are again losing out on people. So simple thing, let us start with the first basic assumption that, let us look at, for example, if supposing I say that you are doing your business only on cash basis, then the amount of profit what you have should ideally be equal to the cash what you should ideally situation out there. That is assuming that you have not bought any new asset and etc out there. So let us start with that kind of an assumption. But in that case, when we look at the profit out there, there are some non-cash items out there, like your depreciation, for example. So even if you have done the business completely on cash basis, there is one monkey sitting there that is called as depreciation, which is not a cash basis, which is basically you are carrying it, that is whatever assets you bought earlier. Now, in order to know what is the cash I have, what should I do? The depreciation amount what I have reduced, basically what I do is I just add the depreciation back to the profit, then I will know exactly what is the cash I have. Am I with you or not? Any doubts at this stage, sir? Sure. So, these are the simple minor adjustments we do. Now, supposing I say that, another example of that, depreciation is one aspect. My entire payment is on cash, whereas my sales is not purely on cash. My sales is partly on credit, partly on cash. That means what is the cash you should have? Whatever is the profit plus minus the receivables still that is there is the cash that ideally you are going to have. Am I with you on this? Any questions coming up? No far? Okay, so far no. Good. So that is basically, so whatever we do. Now I take the third situation. Now what did we do? We took the first situation, depreciation. We looked at the second situation, that is what we call it as credit sales. Now I look at the third situation. Supposing I also make partly cash purchases, partly what is called as credit purchases. Imagine there is no opening and closing stock. Let's imagine there is no opening and closing stock. Then what do I have to do? I have to take the profit, add back the depreciation first, then reduce the credit sales part of it, then add back what is the credit purchases part of it, because payment has still not gone. So that is the cash what I will have. Am I with you on this? One more googly out here. Supposing I make payment of wages to my staff, employees, and I am making the payment only on the 7th of a particular month, because as per Industrial Act 7 is permissible. Imagine it's a age-old manufacturing company, and I am preparing this cash flow statement on the 1st of a particular month. Now what happens? Wages as an expenditure I would have recorded in the P&L, but payment is not made. So what do? The profit plus depreciation minus the credit sales plus the credit purchases plus the wages which is yet to be paid out there. Am I with you on this? No, that is all what is cash flow statement. Some idea about it? Made it as simple as possible. That's all. So what are we trying to do? We are trying to trace the cash. We are trying to know what is the cash that you have. That's all. Let me sort of relook at this particular exercise what we did. If we look at this, we started off with something called as sales, which was about what is called as, that is in this particular exercise out there, you had sales which was something like 30,650. I am revisiting this. Please understand, if you have understood in the last class 15 minutes, you got to sort of 10 minutes or 15 minutes, you got to sort of relax and enjoy. That's all. Otherwise, if you have not understood, you can try and understand now. Now, what do we see in this? Now, actually, have you received all this money that is basically return as sales out there? Because partly credit sales is there. That we all know. So what is the amount of credit sales that is there? You just have to look at what is called as a balance sheet in this particular aspect. If you look at the balance sheet will show what is the credit sales, because that is the money that I am yet to receive on the sale. That will show as what? Debtors and creditors. Now, when I make what is called as a purchase out there, then what happens? I am to pay. I have to pay. That becomes what is called as a creditor. That becomes what is called as a liability. When I have to receive, that is basically an asset. That is what we call it as debtors out there. With you on this? Now move ahead. Well, let us move ahead on further on this. Now in this particular case, 30,650 was basically the sales what we had. Now if you look at the balance sheet says there is a debtor, that is as of this particular year. If you look at sundry debtors as on this particular year is 1700. Am I with you? That means going by the principle what I just said, that 1700 rupees you have not received. So what do? I reduce that 1700. Am I with you or not? So what do? That is minus or a negative part of it, of what we call it as end of the year receivable or debtors closing. That is basically what we call it as 1700. Negative. I've just put, let me put a minus sign right here also for clarity. But at the beginning of the year, you had 1200 out there of receivables which was due for last year. Let it pertain to last year. But when are you receiving the cash? This year. Sir, I might not have received the cash. Somebody might argue that what was due last year is still continuing to be due last year, is still continuing to be due this year also. Perfectly fine. If it is still continuing to be due this year, it would be part of that 1700 which is already noted out there. So what do? So that what is called as what we will say what is called as debtors opening, or that is I would have ideally received, or if it is not received, it is part of the 1700, then that will become what is called as 1200 out there. Then your total, what do you call it as, your cash inflow from what is called as your operating activity. We said 3 activities, right? I think I spent some time on that. There are 3 activities. What are those? Operating? Financing, investment. Beautiful. At least that's great. So there's some value addition that I'm very happy that having coming here. Okay, fine. Now this is part of the operating activity. Because of an operating activity, there is cash coming into your business out there. With you on this. Now, similarly, there are other aspects which we need to look at. The other aspects which we need to look at is, one aspect what we looked is the inflow of operation. Let us look at the outflows because of operation. If I have to look at the outflows because of operation out there, what are the first and foremost we will see in this particular aspect out here? We see that there is what is called as cost of sale of 26,000. Let me just move this. You can consider, supposing I know that the 1200 is that 1700 due at the end of this year, the 1200 which was due at the beginning of the year is continuing. That means out of the sales of 30,650 this year, what is not received still? Only 500 is not received. So what do? 30,650 minus 500 plus the 1200. Either way, it is going to be there. Not addition. See, what is there? Status at the end of the year. This might include what was due last year. This might include everything fresh this year. That we are not worried about it. We are worried about what is due, what was due at the beginning. See, what are you liable to receive this year? Whatever is the sales of this year plus whatever is the due last year. That is the total amount I am eligible to receive. Out of the entire pool, how much is still receivable? 1700 is still receivable. That's all. Let us take it that way. What is the pool receivable this year? Pool receivable on sales is 30,650 plus 1200 which was due last year. That is the total amount of cash I am eligible to get. Out of that, what is due? 1700 is due. This 1700, for all you know, or the 1200 which might be getting carried forward, might be a due which is 10-year-old also. You and I don't know about it, and we are not worried about it as of now. Understand, sir? Do we move on? Okay. Now we are looking at cost of sale. Cost of sale is what? The amount that you have spent on basically getting your goods ready for sale. That means ideally that is the amount you would have ideally spent in whether it is raw materials, etc., etc., etc. out there. Now if I look at what is my COGS out here, my COGS in this particular case is basically 26,000. I'll do one more numeric also, 11.4 also we have planned to do, right? So try and follow this. 7.4 is a little more simpler one. Now first thing, that is cash outflow payment. Madam, we are revisiting the same problem which we did in the last class as I had indicated in the email. Now that is a cash outflow. Now is this entire 26,000 which is appearing in the P&L, is the money completely gone out? We don't know. So let us look at what are the first aspect out there. I look at corresponding. If you have not paid, it should appear as? Now we are confident. Okay, fine. Because it has to be, because we have free debtors. It has to be only creditors, right? So it is a liability. Now that it is a liability out there, creditors part of it, let us look at what was the creditors at the beginning of this particular year. Opening creditors. If you look at the opening creditors was about 1,890. That means why am I putting plus out here? That is the total payment that you ought to make, that liability for your cost of sale. This year's is 26,000 and last year's is 1890. The total payment you have to make is the quantum of this plus this put together. Am I with you on this? So far so clear? But ideally, how much have you paid? There is still some amount I am yet to pay. That is what is called as closing creditors. If I look at the closing creditors is about 150 is I have not paid. Whether this 150 is from the 1890 or is it from the current year's purchases, we don't know. But as of today, that is what you have to pay. With you on this, so far so good. Now the next aspect comes in. What is the next aspect that comes in? The next aspect that comes in is basically your stock part of it. Now this 26,000, imagine, don't use the word cost of sale, just keep it as raw material purchases. Creditors also pertain to raw material utilized. What will appear in the P&L? Whether it will appear as purchases will appear or utilized will appear. Why utilized? Beautiful, sir. Fantastic. Fine. At least now it's working. This is a quiz what we have, right? Informal quiz. No evaluation for this. Don't worry. No, it's good. Because what does appear in P&L? In P&L, what is consumed, what is pertaining to that particular year? I have sold 100 units. What is the material that I have consumed for 100 units will only appear in the P&L statement. With you on this, Joel? Sure. Okay. Now, given that, out of this, what is called as 26,000, imagine, let me sort of, what is out, basically strike it out and just say raw materials utilized, RMU, that is what raw material utilized. I've just taken it as raw material utilized, you don't have to do it for easier understanding. Out of this 26,000 raw material utilized, I might not have bought everything. If I have not bought everything, there is no cash outflow. Even if I have bought, you would say there is creditors, that we have taken care of it, right? You would not have paid, etc. You might not have bought, you might have utilized everything that is there in the inventory that is already there, which you would have bought it last year itself. Possible or not? Yes, possible. So let us look at what is the opening inventory in this particular case. Out of this 26,000, I have not bought goods worth 1950. That is what is called as the opening inventory out there. Look at the asset side. Look at the asset side out there. Opening inventory, if you look at, is 1950. There are two events. When I make a purchase, what happens? There is a good that is coming in. That is one part of it, my inventory. The other side of it, what is it? I have to pay. Cash goes out or creditor. Two independent events. Inventory is in one side, inventory has increased, one side liability has increased. We looked at the liability part of it. Now let us look at the inventory part of it. Right? There are two parts. Now when I am looking at what is called as, yes Abdul, yes Joel, yeah, question. You clarified. Okay, that's good. Fine, thank you. Now what happens in this particular case, if you look at, out of this 26,000 rupees worth of raw material, forget about creditors. Creditors is when you make a purchase and a sale. Imagine this 26,000 worth of goods I have bought this particular year. That is what you imagine first. And that is when you took at the creditors, opening and the closing creditors what you basically had. Opening creditors what I had in the sense, I might have utilized so much of raw material. But what is the amount I am liable to pay? I am liable to pay for what I have utilized plus what I have to pay last year, plus there is one more piece, that is what is the stock, that is amount that is also left in your inventory. Am I with you on this? That we will come to that. But at the same time, this 26,000 rupees worth of material, I have utilized it. But entire thing I might not have bought. I might have used something which is there from my inventory out there. So what do? I am looking at what is called as my opening inventory negative. The amount is about 1950 if I am not wrong. So I'll explain what I have done. I utilized raw material for 26,000. I had to pay last year 1890. This is my total liability that I have to pay. 150 is still due this year. So the total liability I have to pay is 26 plus what is due last year minus what is due current year. Now, out of this 26 I have utilized, I have not bought the entire thing this year. There is something which is bought last year, or year before or whenever. So what is liability? What I have utilized plus what is due last year minus what is due current year plus minus what is the inventory I have utilized from my in stock out there. Now again further to that, I need to look at my closing inventory. My closing inventory is there. There is a lot of stock lying in my what is called as my godown out here. This particular stock also I would have bought it, but it will not appear in the P&L. I have to pay for it. So end result, two different aspects. One is we look at the creditors, other is we look at the inventory. This 26,000, what is the amount of goods utilized? Amount of good utilized is 26,000. What is out of that? What is the good you have bought? 26 minus 1950 plus 900 is the good that you actually bought. First get that clear. Now what is it you have to pay? You know what you have bought, plus you have to pay for last year's also, minus what is the due current year. That is all what we are getting out there. Am I with you on this? Yes. Everybody clear? That's great. Now we move on beyond this. I move to the next page out here in this particular case. Now what we have, the next aspect out here in this particular case is, there is other expenditure in the P&L statement. That is what is called as admin expenditure, admin and selling expenditures out there. This admin and selling expenditure, if you see that, there is nothing which is correspondingly, if you have not paid it, it should appear as a liability. Either this year or if you have not paid, even last year, that should appear as a liability. Supposing last year there was a liability of 500, this year liability is 0. That means what is the cash outflow? 910 this year plus the 500 of last year. Obviously, there is nothing in this particular case. You are paying out there. So, admin expenditure, your minus your 910 if I am not wrong. In this particular case out there. So far so good. Any questions, Pratik? So far they are also following? Check, put a chat and check if they are. All of you are following? You can, if you are following, just say that you are following. That's all. Just put a chat message. Move beyond this. Now, if we move beyond this, there is what is called as the next aspect pertaining to my operations. If I look at in this particular case, depreciation, we have not worried because we are not looked at. We are looking at only what is called as your cash expenditure is what we are looking at. This is what we call it as direct method, etc. Yeah, cost of goods sold subtracted. That this is cash outflow, that is cash inflow. Oh God, I got to put it out there. This is all, please note, outflow. I think I can color it if I'm okay. I'm not sure. I'm not getting it. So I don't want to try all that. Right? I will just put, okay, beautiful. I got it. I got it. And then let me just move what is called as this is inflow. Yellow is too light, but it's okay. People can see it. Not a problem. Right? Now we are looking at further. Clear? That part of inflow, this part of it is flow. Now, interest expenditure, as I said, it's part of financing. Investment income is part of investing activity. Dividend income, investing activity. Let's not worry about it. Extraordinary items. Insurance proceeds from a disaster management fund out there. Insurance proceeds from what is called as a disaster management fund. That is, you have received that money. There is what is called as a cash inflow that has occurred. That is what is called as inflow from disaster management 140. Please understand, this is an inflow, the rest are outflow. Minus and plus you can just take care of it. The next aspect out here, what we look at is what is called as, there is something called as taxes on income, $300 out there. Taxes on income, there is what is called as $300 out there. If you look at the taxes on income, $300, that is the ideal tax which you should have paid. What is it that you are liable to pay? Malika, what is it that you are liable to pay? Taxes. $300 is a tax for the year. 300 is a tax for the year, but total liable tax you are liable to pay this year. What is it? 1,000? 1,000 from previous year. If I look at the tax payable, income tax payable, 1,000 from previous year. What is the cash outflow? 1,000 plus 300 minus 400. That is the cash outflow. This year is about 900. Now 1 second for that. Out of that 900, if you read one of the statements in the second part of the statements which is in the page 2 of the case, it says that, talk something about tax deducted at source for dividend income or some one of the investment income out there. Some $40 worth of tax that was deducted. Which point number is it? 4. Point number 4. So, that $40 tax is not pertaining to operations. That $40 tax is pertaining to investment activity. So what is the tax? So 900 minus that 40, $860 is basically the taxes that is their cash outflow. With you on this? So far so good? Now, can you total all this? What is the plus minus all the inflows together and all the outflows together? All the inflows together, all the outflows together. $1830? 1830, should be 1830. Cash flow from operations. Positive out there. Just put it and check. It cannot be 10 rupee difference, cannot come in, right? Then you're totally mistake. If it's one of the figures, the difference, ideally if you get it, it should be one of the figures what we have entered, because that is what you would have, instead of plus or a minus you would have done it, so it should be double that figure. That is the kind of difference. You cannot get 10 rupee difference anywhere unless you are doing a totally mistake. Now, we move to the next aspect out of it. when we talk about the next aspect out here, we are looking at cash flow from investing activity. Cash flow from investing activity. When I am looking at cash flow from investing activity out here, when I look at cash flow from what is called as my investing activity, let me sort of look at cash flow from investing. Yeah, now I got it right. Okay. Cash flow from investing. Now let us look at it. Let us go back to the same thing out here. If I look at, if we go back to the same thing out here, investing activity, what is the investing activity? There is an investment income, there is a dividend income out there. These are the two basic aspects that is there out there. Now, there is what is called as inflow from investing income. Then there is what is called as dividend income. If you look at the investing income, the ideal investing income what you would have earned is about $300 out there. Yes or no? Yes. Is that still due? If it is still due, it should be there on the asset side. Is there anything due from the last year, current year? Anything due from the last year, from the current year? Anything out there? No. Nothing? Sure about it? Yeah, last year dividend investment was 2,500. Investment, it remains the same. That has not changed. So there is no fresh cash outflow. There is a dividend income which you have earned, that is investing income, that is about $300 which you have basically earned out there. Am I going right? Okay. Now you have earned about $300 and your dividend income is about 200 is your dividend income out there. 200 is basically dividend income. Then there is a cash outflow in the sense of, that is what I am coming to, outflow. That is because of basically tax on dividend. Anything else on investing? Purchase of? Sure, go ahead. Yeah, you're right. That you are investing. Perfectly fine, ma'am. Go ahead, ma'am. What is purchase of? No, one second, ma'am. Malika. What is purchase of machinery? Asset. So what are you doing? You are investing in buying an asset. So you are right. So don't be scared. Right, that's all. You are investing in purchase of an asset. Perfectly fine. I started with these two easy ones so that then we'll move on. If you look at my plant and machinery out here in this particular case, my fixed asset gross, I'm looking at fixed asset gross, I'm not looking at fixed asset net out here. Fixed asset gross at cost was 1910 last year, 2180 this particular year. That means 1910 has increased to 2180, that means it has increased by $270 totally. But if I look at $270, is that all what I have purchased? Let me read the statement which is there in the second page of this of the sheet out here. It says that during the period, I am talking about point number 1, 2, 3, 4, 5, point number 5 out here. During the period, the enterprise acquired property, plant and equipment for $350. Cash payment of $350 was made on purchase of the property. With you on this. So what happens? There is a property purchase, $350 out here. Outflow, negative. Yes, John.
There is an interest receivable.
Interest?
Receivable.
Then that means I must have ideally missed it out. Yes. Interest receivable $100. That means what happened? Investing income 300. Now what is it? Receivable is 100. That means what should this be? I made it. Thank you. Thank you for pointing it out. I missed it. Thank you for pointing it out. Pratik, you have to be more careful. You have to watch out what I am doing. Right? Correct. I mean, if I am missing out, you have to tell me. Now, I go back to plant and machinery. Thanks Joel for pointing it out. I go to point number 6. Point number 6, a plant at the original cost of $80 and accumulated depreciation of $60 was sold for $20 out there. That means what has happened? Investing activity has yielded you what is called as a cash inflow of how much? Of about $20 out there. Let me look at what is called as sale of a plant, $20 out there plus. I'm going to repeat this. What is the difference what you saw out here? The difference in plant, I'm going to use this part of the board also slightly. If you look at the plant and machinery out here was opening was 1910. Opening was 1910. What is closing? Closing, if you look at closing of plant and machinery, that is at the end of the year, balance was 2180. The difference, what you see, is 270. That means 270 worth of plant and machinery is what ideally you think you would have bought. But whereas it says $350 worth it has bought, and then it has sold something worth about 80, 60 or 20. There are 3 figures in that statement. Sure. How many of us say 20? Yes sir. Yes Joel. 5. What is this value? This is the gross value of the asset out there. Gross value means the purchase value of the asset out there. Please look at the balance sheet, sir. I have not taken the net value. What is this value? This is the gross value, purchase value of the asset. That is prior to depreciation. Now, what is this? Purchase value of the asset. Now, what is the value of the asset you have sold? The value of the asset you have basically sold is only $80 out there. That is the gross value. So, the net effect on the gross value in this particular case is 270, and that is what you see there. Right? So far so clear? So, cash flow from investment is $30 is what is the total after all these additions and subtractions is $30. Fine, you are right. Right? But this goes into what is called, to arrive at the 30 you need this. To arrive at the 30 you need this. Right? 30, that number is right. That's all.
I just mistaken this.
Yeah, that's fine. That's okay. No problem. So what we have done is basically we have talked about plant and machinery, we have talked about interest, we have talked about this, and this total is basically what we have. Anything else pertaining to investments out there? I don't think anything else is there pertaining to investments out here. So the total of all this is basically what we have out here. If you look at this total, that means cash flow from investing. You can total this should get about $30 out here. Yeah, obviously, if a plant origin costing at originally 80 was sold at 20, you are not assuming, you are not worried whether it is depreciation or loss. That is none of your botheration when you are doing a cash flow statement. That will be a part of worry when you are doing a P&L.
Yeah, so for cash flow, this is additional information.
That is additional information. That is just to confuse you. I asked you 3 figures, right? So you got to shell out which is the figure. That's all. So don't worry. So it's kind of some numbers which are irrelevant might all be there, or you can say that is an additional information. That's a beautiful way to say that. Otherwise, I can say it is to confuse you. Either way. Now that you have done this, let us look at cash flow from financing. Any questions so far, Pratik? No questions? Okay. Check if all of them are following once in a while. Right? Put a chat message and check if all of them are following. If they're not following, then we have a problem. Now I go on to the next aspect. That is what we call it as financing activity. When we say financing, what is the first thing? You are looking at which side of the balance sheet? Asset side or liability side? Predominantly which side? Borrowing will come in the asset side? Borrowing will come in the asset side, sir? Sir, we have to go back to class 1 then. Simple, sir. Please understand. Sources of finance, sources of funds, utilization of fund. Investing is utilization. Did we ever look at the liability side for investing? We looked at what? Only the asset side. Because what are we looking at? Investing. Here what is it? Sources of finance. Please note, sources of fund, utilization of fund. Utilization of fund is your asset, sources of fund is your liability. So when we are looking at sources of fund out there, so we predominantly start with the liability side. What are the major sources of fund? Two, debt and equity. Right? Let's get that very clear. Debt and equity. Plus all other your current liabilities in terms of creditors, which is also sources of fund, we have already accounted for it in operations. Right? Per se, we have to look at only two aspects. What are the two aspects? Debt and equity. Debt means loan, equity means what is your share out there. That is all what I am going to look at. If I go back to my balance sheet out here, it says that long-term debt and then on the other side what is called as share capital. These are the two things, right? Debt and equity. Now, if I look at the debt part of it, in this particular case, we see that on the what is called as equity part of it, it says equity share capital, which was 1250 last year, has become 1500 this year. Yes or no? So can we straight away take it? It is $250 increase. There is a cash inflow. Yes or no? How sure are you that this $250 of share capital increase has not happened because of a bonus issue? Right? You know bonus. I taught you what is bonus issue. Right? I taught you what is bonus. If it is a bonus, is there a cash inflow? There is no cash inflow. Normally, if there is a bonus issue, to that extent, your reserves and surplus would also change. To that extent, where do you get your bonus money of bonus from? From your retained earnings. Retained earnings is part of your reserves and surplus. To that extent, that would have also changed. Of course, one can argue, I would have taken out some money from retained earnings. I would have added this year's profit also to the retained earnings. So all that jugglery. Let us not do that jugglery. I made it a little more simpler out here. In the sense, if I have to, this is the if I have to make it a little more simpler, just to moving away from it. Imagine share capital last year, that is opening, was about 500. Share capital closing 750. My reserves and surplus last year, that is opening reserves and surplus, is about 250, or let us say 350. My closing reserves and surplus is about 400. Then what you would say? Oh, it has not decreased, it has rather increased. So this should be what is called as fresh issue of shares, and you have collected money. Need not be. Imagine this is what is called as, I am doing it for the year 17-18. This is 16-17. That is what opening is your end of 16-17 or opening of 17-18. Now during the year 17-18, I might have made a profit of about, I might have made a net profit of about $300. If I have made a net profit of $300 in the year 17-18, what should ideally be my reserves and surplus? Imagine there is no dividend. That means 350 plus 300, 650 should have been here. But what is here? 400 is here, and 250 has increased. So what do? If you have not given dividend, you have basically moved it to the, float it to the bonus kind of an issue out there. So let us not do all that jugglery out here.